Today, we will discuss the book that sold millions of copies, How to Make Money in Stocks, A Winning System in Good Times or Bad, by a legendary investor, William O'Neill. William O'Neill turned his initial $5,000 into more than $200,000 in his 20s during 1962 and 1963. He was interviewed in one of my favorite books, Market Wizards by Jack Schwager. He also became the youngest person to purchase a seat on the New York Stock Exchange. Through his famous Can Slim strategy, he has helped millions of people with their investments. William O'Neill analyzed hundreds of the best performing stocks over the last 100 years, such as Texas Instruments, Xerox, Syntex, Resorts International, Apple, and so on. You might have recognized that some of the companies still exist today. And he has discovered that they all had Can Slim in common. Can Slim is an acronym where each letter stands for one of the 7 important characteristics. Now let's look at what each letter stands for in Can Slim strategy. C. Current quarterly earnings. Every 3 months, every listed company releases their earnings report, and investors get to know how well their companies have done in the latest quarter. EPS, or earnings per share, is calculated by a company's total after-tax profits divided by the number of shares outstanding. Let's say the size of each tree represents a quarterly earning. The higher the growth, the better it is. Earnings per share should be up at least 25% in the most recent quarter compared to the same quarter in the previous year. Mr. O'Neill says find companies that report big and accelerating earnings per share growth in the current quarter compared to the same quarter last year. Also, the earnings in the latest quarter or two showed huge profits before their stock price made a huge run upside. A. Annual earnings growth. On top of big current EPS, a company's annual earnings growth should also be considered. The reason is, for example, a company that makes computers can earn extraordinary gains from activities such as the sale of real estate in 1 or 2 quarters, which will look like their earnings have significantly increased during that period. By looking for 25 to 50% or higher annual earnings growth rate over the last 3 years, we can increase our chance to find a better company. Another measurement to look at is return on equity, which is calculated by dividing net income by shareholders' equity. It shows how efficiently the companies manage their money. According to his research, the greatest growth stocks of the past 50 years had return on equities of at least 17%. N. New product or service, new management, new market conditions. William O'Neill discovered that in their study of greatest stocks, more than 95% of successful stocks between 1880 and 2008 fell into one of these categories. It is new products or services that sell rapidly. It takes something new to produce a big advance in the price of a stock. The new product or service causes earnings to accelerate faster than the previous rate of increase. Or it can also be new management that brings new vigor, a new idea, or at least a new way to clean up the old inefficient management. New industry conditions such as the introduction of revolutionary technologies can also have a positive effect. S stands for supply and demand. The price of almost everything in your daily life is determined by supply and demand. This basic rule of supply and demand also applies to the stock market. A company that issued 5 billion shares outstanding requires a much bigger volume to increase than a company that issued 50 million shares outstanding because of its bigger supply. Acute investors take one step further and look at the floating supply. Floating supply shows the number of shares that are available to trade to the public. It is calculated by the total number of shares outstanding minus closely held shares. Companies in which their management owns a large percentage of the stock are generally better. Looking for companies who buy their own shares in the open market is a good way to check its supply. The effect of the buyback is to reduce its total number of shares outstanding, so it increases the earning per share and so does each investor's stake in the company. But the company should already report the steady growth in earnings. And a company with low debt to equity ratio is better Earnings of companies with high debt to equity ratio could be clobbered when the interest goes up or during recessions. He says the best way to measure a stock's supply and demand is by watching its daily volume. When a stock pulls back in price, you typically want to see the volume dry up, indicating that there is no further selling pressure. L. Leader or laggard. People tend to buy the companies that make them feel comfortable because the price decreased significantly and suddenly looks like a bargain. But the chances are that you have picked a stock with fewer potentials. Always pick the best 1, 2, or 3 companies in a strong industry group. The best companies don't necessarily mean that they have the biggest market capitalization or they have the most recognized brand. They're the ones with the best performing quarterly, annual earnings growth, the highest return on equity, and the widest profit margins and the strongest sales growth. I. Institutional sponsorship. It needs a strong demand to push the stock price up. The biggest source of the demand is Wall Street Bets on Reddit. Just kidding. It is institutional investors such as mutual funds, pension funds, investment banks. But William O'Neill doesn't consider brokers' research reports, analyst recommendations, or market newsletters as institutional sponsorship. It may exert a short-term impact, but they don't have the sustained buying power of institutional investors. Any best stock must be owned by at least 20 institutions ideally. If a certain stock has no professional sponsorship, it's likely to have a hard time going up because more than 10,000 institutional investors didn't find it attractive to invest. Last but not least, market direction. He starts this chapter by saying, you can be right about the first 6 key factors, but if you're wrong about the direction of the general market, your 3 out of 4 will plummet. General market refers to the major indices. If you buy stocks in the United States, there are Nasdaq Composite, S&P 500, and Dow Jones Industrial Average. It shows how important and necessary to read not only the direction, but also the stages of the market cycle. Are we in the middle of the bull market? Are we nearing the end of the bull market? Or are we at the bottom of the bear market? The best way to find out about the market direction is to observe and study the indices every day. In doing so, you'll be able to recognize when the daily market indices are changing at key turning points. The bear market tends to open strong, close weak. And the bull market tends to open weak, close strong. The second best way to find out about the market direction is to observe how the market leaders move and study them. This skill takes time, but eventually you'll be able to anticipate the changes. Do we have to look at charts? In the book, he stresses the importance of technical analysis a lot. That's why he illustrated more than 100 pictures of charts in the book. Looking at these charts, I can start to recognize some common patterns in them. He says many stock professionals often overlook charts, but he believes that reading the chart patterns and price movement is necessary along with thorough research on companies. These both together have made him successful in investing. Just like a doctor gives an X-ray and an MRI to assess a patient's current state, charts are the pictures of how stocks have performed. Charts are like maps. They tell you where you stand now, and it tells you where to go in the future. One of the most common patterns we see is a cup with handle. The cup patterns last at least 7 weeks to 65 weeks. Mostly it takes about 3 to 6 months to form. It is good to note that the shape of the cup should be a U-shape because this long U-shaped cup takes weekends and speculators out, and only solid strong owners who are not going to sell in the next price advance are established. The formation of the handle part takes more than 1 or 2 weeks, and it has a downward price movement with lower volume. The handles almost always form in the upper half of the cup, and they should be above a 10-week moving average. He says we want the stock to prove its strength before we invest in it. Therefore, we should wait until the price goes back up to the highest point in the handle part. This CanSlim strategy helps us with what to buy and when to buy. But now you must be wondering when to sell these great stocks. When to sell. When to cut losses. The whole secret to winning big in the stock market is not to be right all the time, but to lose the least amount possible when you're wrong. Successful people are not always lucky, and they just try harder and more than average people. William O'Neill follows the 7 to 8% cut loss rule, and there's no exception. He also says the smaller the cut loss is, the better it is. Knowing that all stocks are speculative and risky, the only way to prevent you from losing 50% or more is to cut losses when they're much smaller. Letting your loss run bigger is the most common mistake beginner investors make. Having no cut losses is like driving your car down the hill without having brakes. When to take profits. He says we need to sell the stocks when they're still strong in the price action. When he decides to sell stocks, he doesn't consider companies' fundamental change. Many big investors get out of stock before trouble appears on the income statement. He says we need to come up with our own profit and loss plans, and some of these technical sell signals will help you. Largest daily price run-up. It is a sell signal when the stock price has the largest daily price run-up side after a long uptrend. Heaviest daily volume. The ultimate top might occur on the heaviest volume day since the beginning of the uptrend. Signs of distribution. Heavy daily volume without further upside progress is a sell signal. Increase in consecutive down days. Generally, the number of consecutive down days compared to the number of up days increases when the stock starts to head down from the top. Upper channel line. We can make a price channel connecting the lows and the highs of the price movement. When the stock price goes through the upper channel line, it could be a sell signal. Now let's summarize the book briefly. For the last 100 years, best performing stocks have these things in common. CanSlim strategy helps us choose the best stocks. These are the key factors: current quarterly earnings, annual earnings, new product or service, supply and demand, leader or laggard, institutional sponsorship, market direction. Reading charts and price patterns gives the idea of where we stand today and where to go in the future. One of the common price patterns is a cup with handle pattern. For selling stocks, basically what we need to bear in mind is successful investing has to do with cutting our loss small and letting our winners run. Selling stocks can be broken down into two things. First, when to sell with losses. 7 to 8% rule was what William O'Neill uses, and the smaller the losses, the better it is. Successful investors always cut their loss really fast. Second, when to sell with profits. There are some technical sell signals we can refer to. Relying too much on income statement could be dangerous because smart money might have gotten out already by the time we access to the information. There is so much other valuable information that I didn't mention in this video. I highly recommend this best-selling book to read, and I hope you will make money in stocks. If you found this video useful, please subscribe and like this video and share your ideas on the comment section. Thank you for watching.